Hey everyone, welcome back to another episode of AWM Insights. I'm your host, Justin Dyer, Chief Investment Officer here at AWM, joined by Mena Hanna, Portfolio Manager, and my right-hand man. Today, we're gonna do a little bit of a fly through of some big topics that have been dominating the market narrative over, in some of these cases for the last couple of years. And in one just this year so far, actually a couple so far just this year. And we're going to call this podcast Trends Come and Go, but Disciplined Investing Still Wins. So talking through some of the subjects, topics, questions of the moment, and why they may or may not be worth pursuing ourselves. Punchline, it's probably not, right? That probably goes without being said for you frequent listeners, but we're going to give you some data and anecdotes around that to kind of to support the conversation here today. But those few topics that are really continuously showing up in headlines, you're probably seeing them on TikTok, socials, etc. Maybe your traditional media sources, Wall Street Journal, etc. First one being Mag 7. Maybe Mag 7 is a little bit starting to fade, but the idea of these large tech companies, NVIDIA, etc., just dominating market performance has come back, right? The start of the year, it was certainly not the case, but it's definitely back, I would say, at the forefront. And we call these growth companies, right? These are companies that cost a lot per dollar of earnings. That's how you think about valuation when it comes to investing. Happy to spend more time on that on another podcast, but these are growth-oriented companies that are back in the headlines and being closely watched across the board. Then there's this idea of you want to call it U.S. exceptionalism. That's not a political statement. It's just this concept in markets where U.S. markets for the last really, I guess, almost 10 to 15 years or so, U.S. markets have outperformed. They've been the dominant player in the global marketplace. And, that's changed really this year. Is that going to continue? Maybe we'll talk about that a little bit. Gold, the bright, shiny object, literally back in the news, had a phenomenal year. But of course, the devil's in the details. And then, all of these can kind of be rolled up into fads, investing fads. I think there's some legitimate questions, and we even always question ourselves or question what fads are potentially here for the long term and what are more just get rich, forcing people to chase the next bright shiny object. Most of the time it is that. I can't even think of one where that it's had staying power. And we did a podcast on that recently, so we won't spend a ton of time on that topic. I'd say go listen to that podcast, but we'll kind of wrap with that general conversation. So without further ado, let's jump into it. So Mena, walk through how we approach the question of, okay, there's been this very small segment of the market that has performed exceptionally well. I would also say, I'm kind of leading the horse here. The market overall has performed quite well, at least this year. But how do we slice and dice this? How do we try to assess this ourselves?
Yeah. And the question that we sometimes get asked is very, very aggressive from the standpoint of, hey, market's doing great, but NVIDIA is doing better. Why don't I put all my money in NVIDIA? And the reason for that is if you actually look at the data, and if you take a step back and look at your portfolios, you hold NVIDIA, you hold Apple. I was actually just talking with one of my family friends who is a doctor, and he was like, I just bought Apple, I'm holding it. That's the only thing that I'm holding. And I was like, I hope things don't play out as they normally have, and we'll get into the data. But you hold all of these companies in your portfolios in the appropriate weights, where I think I was looking at it the other day, every one of our clients has around 6 to 7% of their US holdings in NVIDIA, which is a decent amount.
It's a lot.
Yeah. And that's the market weight. That's how much you should hold. There's a huge difference between holding 6 and 7% and 50 to 100% because you're all in on one position. Don't do that. So you do hold it in the right weight, and you have to think about it as, having a pitching rotation instead of signing one guy to a $200 million deal.
Yeah, putting your eggs in one basket right there, right?
And calling it quits after that. So that's, I would say, the starting spot. The interesting data, and we'll share a few of these slides here for people listening on YouTube, but you can see here what it actually looks like after a company joins the 10 biggest companies in the stock market. And this data goes back pretty far, back to the 1930s, I believe. You can see that companies typically outperform the market for 3 years by 0.7%, but they typically grow so large and so much capital moves into them, with also the headwinds of technologies always evolving. There's always new ideas. So performance in the later years really drops off and significantly underperforms the market. Nokia is a great example of this. Everyone was all in on the cell phone in the late 90s and 2000s. It was one of the 10 biggest companies in the world. And, now it's obviously not, because technology moves along. So yeah, we'll put some 2 other slides here that are interesting. There's only one company that was in the 10 largest company list in the year 2000 that still exists on that list today, and that's Microsoft. Everyone else here, you can see Cisco, GE, they've all dropped off because there's been new companies, new entrants, new technologies, and yeah, that's the way markets work.
And there's a logic. You kind of touched on it. There's a logical framework as to why this should be expected to continue. I mean, yeah, maybe there's a chance of one of the current top 10 being there 10, 20 years down the road. Picking that one today is incredibly difficult. That's a very low probability decision to make. But I mean, you coined the term or originally said it. There's financial physics here, right? When a company, this is kind of what you alluded to, when a company gets so large, you just think about the ability for a multi-trillion-dollar company to double or triple from that point. It's incredibly difficult versus smaller companies. The amount of money in the world can go to those companies a lot easier and potentially multiply them much faster. So I think that is one thing to always keep in mind, this idea of financial physics. It's true across markets. And then you were going to say something, jump in.
Yeah, I was just going to say, this is a curveball for all our clients listening. I've heard so many times, dang, I wish I got into NVIDIA 5 years ago. That's like, and you're right. Like, you would have 12x'd your money. The return's 1,200%. One thing that no one is talking about, Build-A-Bear, over that same 5-year period of time is up 3,200%. So that's like 2.7 times the performance of NVIDIA. And it's for the same reasons you were talking about. It's a smaller company. They've improved operations. I believe they've done a lot on the operational side, but they're so small, and that kind of any improvements can be rewarded at a much higher level. And you don't need, NVIDIA right now to double needs $4 trillion to flow in. It's a lot of money. Yeah.
And so the other thing I was going to say is just this idea. It's a beauty in a way of capitalism, right? Creative destruction, right? Capitalism has competition at its core. And so those on top, right, they are making a lot of money, which is why they're valued the way they're valued. And then competitors are going to come into the marketplace and challenge them. And so it's another thing to keep in mind, right? And there's no reason to believe these two forces are going to change. And to your point, Build-A-Bear, you want exposure to Build-A-Bear. It's not the one that's getting all the attention, but that's why we're disciplined and diversified. Okay, cool. So that's talking about, a small number of companies dominating performance, why you don't want to go chase those. The data just really doesn't support that, especially from a forward-looking basis, right? The odds that those continue to dominate performance are very, very low. we're going to switch gears to U.S. exceptionalism. I mean, I say switch gears, but they're kind of related here. But this idea that U.S. markets have dominated, they've done exceptionally well. They're the largest market on the public side in the world, and we favor them. Right? We actually overallocate to them relative to the general market capitalization around the world. But when we think about, hey, should we just completely forget about international, emerging, other markets and just go all in the U.S.? I mean, I guess the logic we're talking about is very similar to what we just talked about with concentration in a few number of names. But let's go to the data as well. And well, first of all, we have to remind ourselves that economies are not stock markets. So yeah, you can make an argument that Europe is further aging or a greater aging economy. I'm not saying that correctly, but hopefully you guys are all tracking what I'm saying here, where then the US, maybe it's not as dynamic, et cetera. Yeah, there's some implications there for stock markets, but you have to remember that economies are completely different from the companies and markets, stock markets within an economy, within a country. But then let's go back and look at the data. Again, there's dynamism in investing in capitalism, in global markets. And we look and it's really interesting to look at where over the last, let's call it 40 years, you could slice each decade up and basically international developed versus US just flip-flops. Which one outperforms the other? The 80s were, let's say, 80s were really good for international markets. 90s were really good for US markets. The early 2010s were actually better for, it was not great for anyone because that was just a weak decade, great financial crisis to wrap that up. But then you look at the lost decade. The lost decade is a term everyone should be familiar with. That was the US. The US markets from 2000 to 2010, if you look at the S&P 500, were basically flat, in some cases negative. International emerging markets were up pretty solid in that period of time. And then now flip-flop, kind of the most recent decade, we're looking at US dominance. So it's very difficult to time these things first and foremost, and then predict the future based on what's happened in the recent past.
Yeah, and I would just add, the way that we like to think about constructing a public market portfolio is sort of like a hitting rotation. If you have 9 guys out there that only are there to hit bombs and just swing for home runs, like, yeah, some games you're going to do great. Some games you're going to have a miserable time, and there's probably going to be, you're probably susceptible to a no-hitter. A no-hitter for your portfolio is unacceptable, and that destroys wealth. So what we like to do, and you talked about international markets, like, yeah, international markets don't have as much juice from a material standpoint as US markets, just based on some of the fundamentals. But that's fine. You're getting decent batting averages, and you're getting companies that hit singles, doubles, and triples, which can aid you in then incorporating a US public market strategy that hits home runs. And then you're not just hitting, 1-run home runs, you're hitting 2, 3, 4-run home runs. So it's about creating a systematic strategy to actually get runs in and not just swing for the fences constantly, because that does not always work.
Yeah, exactly. And this year is a great example of it. Now, we don't look at one year and extrapolate that into long-term trends, but it's worth highlighting international and emerging markets have dominated this year. And I don't think anyone necessarily would have predicted that. It's been a good year overall for stock markets, equity investors, but international and emerging has done exceptionally well, and we're happy to have exposure to that as a perfect example of what you're saying. All right, kind of turning to the home stretch here, gold. The bright, shiny object literally is been definitely in the headlines lately. We could do a whole conversation around gold. We typically don't allocate to gold. I'll just kind of give you quick cliff notes here, because it's just incredibly hard to value, right? There's no cash flows. There's actually very little industrial use for gold. It really is a speculative asset. And I'm not saying speculative in like a crazy strong negative connotation, but it is. You're just betting more or less that someone is going to pay a higher price than you the next trade or when you go to sell it. But it's done very well this year. There's no way around that. But we want to take a step back and say, okay, does that change our general theory and thesis around gold? The short answer is no, but let's go into some data.
Yeah, and the data is fascinating here. I'll throw this slide on. You actually just broke even on gold on an inflation adjusted basis if you invested in 1980. So even though your gold was appreciating from a dollar's standpoint, like an ounce of gold, you could see price went up, inflation actually outpaced how much gold went up. I know everyone talks about gold as an inflation adjusted play, but you have here a 45-year period of time. I'm definitely not 45 years old. I know the vast majority of our clients also aren't. There's a 45-year period of time where you got a zero on a real basis. That's tough. And that's because gold is a speculative asset. Obviously, there's been a lot that's happened in the past 5 to 10 years that has led to gold recovering, but we don't want to allocate to an investment that does not have financial utility, doesn't make you money, and historically has not yielded a significant return for an extended period of time.
Yeah, that's right. I mean, you're talking a 45-year time frame, but even if you go a little bit shorter, yeah, it's done well over the 5-year period, but it still hasn't even performed what the S&P 500 has done. So I think a lot of that has to do with what you're saying, right? The value drivers, value creation, cash flowing companies are in the S&P 500. Gold is a speculative asset, and it's hard to get speculation right? It's like there's a spectrum here, but there's a lot to be said or potentially compare gold and more speculative type investing to gambling, right? We always say we want to be the casino, not the gambler, and I think that analogy applies there. So,
and one thing I'll add, gold does not give you, obviously the financial utility comment, gold doesn't give you any passive income. A reason that we love investing in public equities and also public real estate is you get dividends on a regular basis. You have that passive income and that cash flow coming into your portfolio that you can use or reinvest, versus gold, you just have X number of troy ounces. That's not moving. You could potentially lose it. So there's other risk factors there, but when you think about passive income too, gold is not the way to actually create that cash flow for yourself for the future.
Yep. Okay, cool. So as we wrap here, I wanted to highlight, actually, there's a great article in the Wall Street Journal by Jason Zweig, who is kind of their personal finance columnist. He must have been listening to our podcast, because he literally wrote an article about why you don't want to trade stocks like a member of Congress right after we had talked about that topic. But the first sentence, the reason why I'm saying this, the first sentence, I'm going to adapt it slightly to us, but it basically was the peak of a bull market and bottom of a bear market have one thing in common. Disciplined investing starts to feel like a waste of time or a little bit boring, or, hey, there's better ways. I'm not, by no means am I calling the peak of a bull market, right? And I don't think he is either, but there's some elements of that going on right now, where you kind of throw out the traditional methods, discipline, et cetera, that we know over time just continue to compound growth and is a better way to invest in a high probability fashion. We say, hey, our job is to keep you rich, not to get you rich. It's very difficult to play investing in this, like, hey, I'm going to play the lottery type mentality or gambling mentality. And so as we wrap, I alluded to, a lot of these are both fads, get rich quick kind of schemes that potentially are being thrown out there under the guise of investing. And it's just great to take a step back. Hopefully it's helpful for you all to hear how we go back to the data, ask ourselves, hey, is there something we're missing here? No, it's not. The data still shows us. We're not going to go chase our tail, chase some sort of fad, because that puts you, our clients, and your priorities at long-term risk, and we do not want to play that game. So hopefully the conversation today was helpful. If you have any questions, follow up, send me in a text.
626-862-0355.
Awesome. And until next time, own your wealth, make an impact, and always be a pro.